the money from the trust just hits their account, and they've been grinding their entire life earning this money, and all of a sudden now they can take a step back. I can't even put a dollar figure on the peace that comes from the truly passive income. And I think any listener out there hearing that, you just put yourself in the shoes of the clients who have been straining and working and striving and building their entire life, and now they can exit, and the trust is growing, and they're receiving that truly passive cash flow, and they feel that freedom for the very first time.
It's incredible, right? It really is, to see the transformation for our clients and to experience it. And, we believe that truly passive income is to your freedom and impact as compounding interest is to your money. And when it gets to that $20, $30, $40, $50,000 per month, and you're not trading any of your time or stress or energy for it, and it's consistent, it's durable, guess what it gives you to do? Hello, everybody. Brett Swartz with Dan Palmer with Capital Gains Tax Solutions. We're here to talk about a little bit about the deferred sales trust, kind of deep dives every week, kind of short, 5, 10, 15 minutes. We'll see how long we go here. Today's topic, Dan, is the power of compounding interest as it pertains to income tax deferral. Dan, they say there's the two most expensive things we have in life, the things you don't know. And number two, tax. Now, tax, the highest of that is income tax. And so I think what gets overlooked a lot when people are looking at a 1031 exchange or a 721 exchange or Delaware statutory trust or a deferred sales trust is the ability to get the tax flow offset with depreciation, but really more so than that, just the ability to not have to receive the income in a given year, kind of like an IRA. So Dan, how does an IRA work? And then how is the trust, the way we structure it and set it up, how is it similar as it pertains to income tax deferral?
Yeah, the great thing about the deferred sales trust is, first of all, the first return on investment is you're deferring the capital gains tax. You have probably 25 to 50% more proceeds compounding and growing in your favor. It's very, very powerful. And just with that alone, the deferred sales trust would be worthwhile. But a secondary return on investment is the interest income that is produced within the trust compounds and grows in your favor as well. You only get taxed on it when you actually receive it. And so if you were just to pay the tax and receive the leftover funds, probably 70% or 40% of the proceeds, and you go invest that on your own, when you receive interest income on it, you're going to pay regular income tax on it when you receive it. But within the trust, you got that 25 to 50% more proceeds working in your favor, and you say, hey, I don't need any payments for 2 years. I'm in the middle of my career. I have other cash flow areas. I really don't want to take it because I'm in the highest tax bracket. You can just let that interest income compound and grow within your trust, and it's capital gains tax deferred, interest income tax deferred until you actually take it. And then once you take it, you're going to pay that regular income tax rate on that interest, but in the meantime, it's really compounding and growing for you.
You nailed it, right? That's a beautiful thing to think about, right? That your income can be deferred until you take it, right? And the note can be adjusted versus like, let's say a 721 exchange or a 1031 exchange, you are going into other assets of which your old depreciation schedule is traveling, which is not good. But B, to the extent those payments are made to you in a given year, and you don't have depreciation to offset, that's taxable to you. It's also a great reason why if you're fully depreciated within your asset that you're holding now, you're missing out a huge opportunity to get your tax flow game higher, meaning more depreciation to offset. I'm going to show this to us today. We're going to do a share screen and kind of build this out together to everyone to give you an idea of what this looks like. This is a little bit of an ROI analysis here. So let me see if I can share my screen here. All right, Dan, can we see this okay?
Yep.
Okay, so let's just take this scenario. Let's say it's a $10 million sale. We'll make it tax-a-fornia, okay? And so we'll just say it's 37%. We won't use depreciation recapture, although that usually adds a couple percentage. We'll use it just simply 37. So that's state of California, 13.3, federal 20%, Obamacare 3.8. It's about 37%. So zero basis, zero debt to keep it really simple. It's a $10 million sale. $10 million into the trust estimated. We'll minus the legal fee here in a second, but we're looking at a $3.7 million tax if you do not use the sale, right? So let's just say the person is going to take $250,000 immediately and use that for the next 15 years, Dan. Okay. The total payout, if you just take 250 every year, at 15 years, you'll have about $10 million. This is, again, not using our structure and our strategy. Now let's move over to the side. Same fact pattern, except you're going to use the trust this time. The legal fee will be approximately about $150K, a little bit less than that, but we'll just use that right now. And the trust fees, depending on how and where the funds are invested, on 10 million, I'm going to put, about 1.85, just generally speaking, okay? But you're going to earn 9.85 hits the trust after the legal fee, earn about 985. This after the trustee fee, we cash flow our fees, so we typically are waiting at least 60 days before we collect any of this. Depending on how and where the funds are invested, will determine other fees, but generally speaking, this is a good earn out here. We're going to use 250 as the same number, Dan, and then we're going to take this down. Okay, so boom, $24 million. Okay, versus $10 million, about $14 million. And you say, Brett, how is that possible? Well, let's walk through that really slowly again. We're assuming about a 10% earnings. Okay, and so we're using that same 10% here. Obviously, the big difference is this tax that you pay up front versus just the one-time legal fee that was paid here. So notice the 9.85 is down. Now, the next thing is there are fees, right? So keep that in mind, depending on the amounts, about 1.5% to 2%, no matter how and where you invest the funds. Depending if you use a financial advisor or not, then it could be maybe a little bit lower, but that's just use just a general framework here. The net proceeds net of fees per year on average, okay, not a guarantee you have to go make the investments, is about $800,000, okay? If you were to live off 250 of that, you'll pay tax. This is the end of the year balance, 10 million, about 10.4 million, which if you go here is in the second year and on and on and on. So the big thing here is the difference between basically column N and column O, okay? Difference between earnings net of fees and gross payout. And this is the powerful compounding effect, because 800 minus 250 is about 550, Dan. That is deferred, right? That is deferred. That's deferred every single year. That's how we get to that 24. Questions or thoughts on that, Dan?
Yeah, whenever I show people these numbers, it normally blows their mind. We talk about the deferred sales trust being an investment, not an expense, because people get caught up on, oh, there's fees. But the fees just get overrun by the gains to where you see, after 10 years, taking 250,000 on both sides, you have 10 million on one side and 24 million on the other. The fees are almost insignificant with the gain to you and your legacy and your estate.
Yeah, it's huge, right? It's huge. And so now a couple things on this for the 1.0 version, that amount could be adjusted. So you might have 0 for a couple years and then 500 starting in year 3. You might have 500 for a few years and then 0 in year 3 and 4. It can be adjusted, okay? It can be adjusted through an amending of the promissory note, but just understand that you are the lender in this situation, right? And the payments can be adjusted, which helps you to maximize the compounding effect of income tax deferral. That's huge. Okay. Number 2, you have some asset protection on this as well. So those funds inside of this trust that's owed to you, right? It's owed to you plus the interest rate, but it's protected from creditors, which is a really powerful part of this as well. And then of course you have an extra 37% working for you. Now these notes can be renewed basically kind of like a refinance every 10 years, end of the term for 10 years. If you have a shorter term, we can renew it for a shorter term. But the point is, some people also miss this too, Dan. They think, okay, this 24 million, let's say at the end of the 15 years, we had a 10-year term and a 5-year term. Are you saying that I have to pay the tax, all of it, all at once? No, people miss this, right? You don't. In fact, you can then renew, refinance this 24 million. And let's work on that a little bit here. Let's duplicate this. Okay.
Yeah, so
And I'm
now
going
the
to use,
starting port's 24 million.
yeah, 24 million. I'm going to put it here. And technically, the tax is still in there. But I'm going to jump over here. You don't have another legal fee, just in case you're wondering. So that's at 0, but it's about 24 million. And to keep everything else the same, these fees would drop some because you're over the 20 million mark. I think, and I'm going to use about 1.75 right around there. Let's make sure this is all the way down. Yeah, 1.75 all the way down. I'm going to make sure I also got it on the last one too, on the fees here. So here, it's about 1.85. Okay. Okay, it's actually a little bit lower on that as I did it. So it'd be like 25 million would be okay. So 25 as I updated the fees all in the file here. So I'm going to use 25. Okay. Again, kind of ignore this left side because you're still in it, so it doesn't really apply. But you get the point here. And let's say increase this to 750,000. Okay. Payout. All right, I have 61 million end of 15 years. Right? Let's take it to a million payout. Okay. I've got 54 million at the end of 15 years. So this is the power of compounding interest for income tax deferral with the DST. We call it the better DST. Now, what do you give up? You give up the stepped up basis, you do, okay? Kids can step into your shoes, they can on our side. On the other side, a stepped up basis would bounce the basis to the new level of when you die or and you pass into your kids, which they could sell at that point capital gains tax free. But Dan, would you want to give up all of that compounding effect of the income tax deferral while you're still alive? See, that's what you have to think about.
Yeah, we have this conversation a lot with clients because stepped up base is a great tool, of course. Who wouldn't want that? But most of our clients are considering the deferred sales trust because they're tired of managing the property. They're getting older. The property tax keeps going up. The insurance costs keep going up. The tenant has all the rights. It's such a hassle to maintain. And so in order to get the stepped up basis, you have to manage that property until the day you die. So that's the problem. So this is a solution where you can compound within the trust and your kids can step into your shoes and continue receiving the payments and continue the deferral. And you can actually exit that life-draining trap that a lot of our clients are stuck in.
Yeah, and what people want, I feel 99% of them, we all want that fourth quadrant in Robert Kiyosaki's Rich Dad Poor Dad book. We all want that truly passive income. We want that ability to be diversified, ability to dollar cost average, ability to go in and out of real estate, in and out of deals, funds or stocks or Bitcoin or different investments, and even partner with the trust to do more deals. And so these are all the really cool things that we want to show you. If you're an advisor, you're a CPA, you're a business broker, M&A advisor, please connect with us because we want to show you how to add value.
Yeah, truly passive income, the power of the freedom. So many people, even they're wealthy. They've got properties. They have assets, but they're worn out. And they're saying, I don't feel free. I don't feel relaxed. I don't feel like the pressure's off my shoulders. And they get into the deferred sales trust and what Brett's talking about, truly passive cash flow. The money from the trust just hits their account and they've been grinding their entire life earning this money. And all of a sudden now they can take a step back. I can't even put a dollar figure on the peace that comes from the truly passive income. And I think any listener out there hearing that, you just put yourself in the shoes of the clients who have been straining and working and striving and building their entire life. And now they can exit and the trust, it's growing and they're receiving that truly passive cash flow and they feel that freedom for the very first time.
It's incredible, right? It really is to see the transformation for our clients and to experience it. And, we believe that truly passive income is to your freedom and impact as compounding interest is to your money. And when it gets to that $20, $30, $40, $50,000 per month, and you're not trading any of your time or stress or energy for it, and it's consistent, it's durable, guess what it gives you to do? It gives you a chance to free and to be able to give more of yourself to your family, give more of your finances to causes you believe in, be able to have time to travel and do the things that you really enjoy and want to do, and focus on your health and focus on your family. Like it's really transformational. And so we want to encourage you to take action today. And if you're an investor, an owner of an asset, and you want to consider your exit planning, we'd also love the opportunity to work with you. You can go to capitalgainstaxsolutions.com to schedule a no-cost consultation with myself or one of our team members to walk you through. Here's the minimum. $1 million net proceeds, $1 million gain needs to be big enough for it to be of value, we found, for the ROI to make a lot of sense. Go to capitalgainstaxsolutions.com. We also have a book that we have here with Kevin Harrington from Shark Tank, which is pretty cool. It's called Building a Capital Gains Tax Exit Plan. You can find that on Amazon or by going to capitalgainstaxsolutions.com. He's Dan Palmer, I'm Brett Swartz, and we'll catch you on the next one. Bye, everybody.